So let's talk about exit strategies. Most people get into cryptos and stocks without thinking about when am I going to take profit or when am I going to get out in a good strategical manner. So in this video, I'll talk about two main exit strategies that I like to employ that help me maximize my gains as well as prevent me from getting super wrecked. So first, let's talk about the strategy of new investors and how their way of thinking actually prevents them from realizing profits. Some new investors see green candles, they're euphoric of all these gains they've made, and they really don't think that the market will ever go down because how could it? It's only been going up for so long. And sorry to be the bearer of bad news, but the market does not go up forever. There will be pullbacks, especially in the crypto markets. As you can see here, the price of Bitcoin went down from 20,000 to 3,000 about, and that is a drop of 85% in price. And if you bought the top, sold the bottom, you would have lost all of that. Another thing that new investors do is they set a certain price point to where either the price of the asset, say Bitcoin, is going to hit and that's when they're going to cash out, or the price of their portfolio as a whole is going to hit and then they're going to cash out. A lot of the times that number doesn't get hit perfectly and they end up holding these bags for a very long time. And that money could have been used to reinvest or invest at a lower price, even if you think that the asset is going to go up in price over the long term, say 20 years. There is still a good strategy in cashing out and buying it at a lower price. And 2017 was actually a perfect example of this. I personally knew people as well as saw a lot of posts online that said that people weren't going to cash out until they hit 20,000. But if you actually look and hover over the candle, you can see the high price right in this area. So it says 19,999. If you had a limit order to sell at 20,000, it actually wouldn't have got hit. Most people were thinking, oh, it'll hit 20,000 or a little bit over 20,000 and that's when I'll cash out. And then they waited all the way down here thinking, oh, it's going to come back up. It's going to come back up. But it actually never came back up. I mean, it did, but not until 3 years later. And your funds would definitely have been better off being sold a little bit beforehand and then reinvested down here, dollar cost average. So what is a good strategy? So the first strategy is dollar cost average out. And a lot of people don't realize that they can dollar cost average out the same way they can dollar cost average in. So if you've been dollar cost averaging here, at one point you could stop dollar cost averaging in, and then at some point up here you dollar cost average out. So you actually set sell orders in different areas of this chart, right? So you could have set a sell order a little bit before 10,000, a little bit before 15,000, a little bit before 20,000, and sold portions of your investment or your portfolio. And that way you converted it to cash. And if you still believe in this asset long term, you can buy in at lower prices. So for example, you sell 10% of your original portfolio at certain points in time, and then you have an average price of when you sold out. For example, you could have either been dollar cost averaging on the way up or had done a lump sum at some point, but it doesn't change the fact that you can still do a dollar cost average out. So say you're up here and you're feeling like, wow, this is pretty crazy. This has gone up way more than I thought it was going to. So you start scaling outward. So you sell some there, you sell some maybe here because you think it's going to go down more, and then you sell some up here, you sell some more up here, you sell some right there, you think it's going to get over 20,000, but it doesn't, and it comes crashing down, so you end up selling here. You kind of miss this one too, maybe, and then you sell here, and then you sell here. But overall, your sell price would have been around this area, right? Which wouldn't be bad. I mean, it's not hitting the exact top, but you're still in profit. And that's all you can really ask for. Don't get too greedy in this space, otherwise you will get wrecked. It's happened to many people, even myself. And if I could say anything, it's take profits when you can. So a little strategy within a strategy of this is to basically, if you've more than doubled what you put in, you would take your initial investment out. So say you put in $1,000, that 1,000 turns into 2,000, you take out the 1,000, and then you still have that money that you put in, and you will never lose that. Because in this space, these cryptos can go down like 99%. And if you put in like 3,000, then it could be worth $10 someday, or even less. Some of them just don't even exist anymore. But those are altcoins that don't really have any good fundamentals, or were scams or things like that a lot of people got into because they felt a lot of FOMO and they felt the hype. So another strategy you can employ is using moving averages. And this is a widely used moving average for Bitcoin. It is the 21 exponential moving average, and that means in the past 21 candles it takes the closing price and gets the average price of all those 21 closing prices. So to get this price, for example, right here at 77.42, you basically take this candle and then the prior 20 candles, add up the closing prices of those 21 candles, and then divide it by 21 to get the average. And that's how you get that specific point of 7742. And what people do is they see how far this candle is from that point, and they notice that, oh my gosh, it's 159% over this, and that would be a really good time to sell. So anything really over 100% or close to 100% is a really big sign, especially on the weekly, that this thing is about to go down. Because this moving average, the price likes to come back down to meet it on the weekly. And if it breaks down below that, that's a really big sign that there's going to be further downward movement. So you can see here that this broke it and flirted with it. That is a really big sign to me that it's going to keep going down. So there's always some sort of pullback. You can wait here and then sell above it, and then see how it came back down again, but came back up to meet it. And it's just kind of trying to meet up with this. So this has been a good indicator of when the market is overvalued, because this 21 EMA is kind of like the fair price for it. So as you can see here, it was pretty far down, and it's a good way to actually think about when to buy these assets too. So that was about 46% below this point right here. That to me says that it was undervalued at that point. So that would have been a good time to buy it. So now let's talk about lump sum. Some of you might be thinking, oh, why don't you just sell at the top? Because it's really almost impossible to sell at the top. You will usually never nail the top. 99% of people don't nail the top. So that's why dollar cost averaging out, or taking out your initial investment, is a great idea. And to really demonstrate this, we'd have to really look on the daily chart, because most people look at this thing daily, right? They don't look at this once a week to see where the price is. So let's go over and hit the replay at a random point in time so we can see how hard it is exactly to sell. So let's just say right here, and then I'm going to be holding shift arrow click to move this. Right, let's zoom in a little bit. And yeah, you see this price going up, price going up. Oh, now it's going down. Scary. When should I sell? So if you would have sold lump sum here, you would have felt bad, right? Because you got scared that, oh, it was going to keep going down. If you sold right there, it went up a little bit. And let's see if this goes down further or up further. And now it's kind of stagnating in the middle. And boom, you did lump sum, and that's okay. So let's talk about the psychology, right? If you would have lump sum sold here and you see this, you would have thought, oh, maybe it's going to keep going down more, and then I can get a better price for it. Then you see this, and then you're like, oh, I'll buy in right there. And then, ooh, scary. It's going to keep going down. You could have sold right there. And then, oh, it's going to take off, so you buy in right there. And then here you're just constantly losing profits. So how DCA is helping with this is that you sell at certain points and then you average at a price in between here, and that way you're not losing profits, or you're not missing out on some opportunities, right? So if you sold a little bit of your portfolio at a certain point here, you could have bought here without thinking, oh, if I sold everything, I have to get it at the best price possible. And another way of thinking too, you could DCA your way when it's going down. So maybe you thought, oh, here would have been a good time to buy it. You could have bought there, and then it went further down, and then you could have bought there. So these things are really hard to time, right? And then boom, it just took off. So if you would have lump sum sold over here, you would have missed out on all of this. But if you sold your initial, you still be making profits, right? And that is almost double what you had in there. And that's just house money now. Whoops. Okay, I accidentally hit the wrong button and it took me to the next chart. So let's go back to here, for example. Right? And you see it keep going up. You see it keep going up. And you think, oh, it's going to keep going up. I'm not going to sell until it hits 5,000. Did it hit 5,000? Ooh, almost. I actually don't even know if it does hit 5,000. So let's see. So see exactly why you stay away from round numbers. It doesn't hit 5,000 and you're like, oh, that's 20% of your portfolio. It's going to keep going down. People get scared, so they sell here, right? And that might have not been a bad time to sell, but then you see that and you're thinking, oh, it's going to keep going down. It's going to keep going down here. So you hold off on buying more, even though you sold here, right? Because you have no idea if it's going to go up or down. And then, oh, now it's going to go back up. So you sold here, but then you bought here, essentially losing that much amount. Anyways, you get the point. The emotions and the psychology of trading are the hardest. So let's actually go back to here, right? Because like I said, you would have bought again maybe at this area, but then again, what if this went downwards? Then you would have sold down here again. And I've seen a lot of people do that. It's something that you think you'll never do, but really when you actually start to trade, and this is day by day, and maybe you're watching it like every couple hours, then there's a lot of emotion involved, and the psychology really gets to you. You flip like, oh, this is going up, oh, this is going down, oh, this is going up. So you just really never know. But like I said, dollar cost averaging is a good way to circumvent those kinds of feelings. That way you only take out a little bit, so that you're not worried about, if it's going to go back up or back down. You already have some in it and you already have some out of it. So hopefully you've, one, taken profits, and two, you're letting the rest of it ride. So another thing to think about is you could also set rising stop losses. So you could set one here, and as the price goes up, you see this, and then you can set a stop loss there. And then you can also set rising stop losses for portions of your portfolio, right? So for example, let's keep moving forward. If it goes down below that area, then a stop loss will be hit, and then it just keeps going up. And now you wait for it to make some sort of base, right, to where you can set your next stop loss. And now that it's done that, you rise up your stop loss to maybe under this wick, or if you're feeling a little bit more confident using the closing price, so maybe there. So you just keep moving it up. Ooh. So let's see what happens here. And boom, it kept moving up. So that stop loss wasn't hit. So now you can move your stop loss up even more to maybe around this area, right? And the price just keeps moving up. So we'll see when it comes down. And these are in days. So, I mean, that's, you know, the 5th of December to almost the end of December. That's a whole month's worth of time. It doesn't feel like it because I'm going through it so fast. So, you know, you could have definitely set a stop loss here as well previously, either here or here, and it would have been hit. And that's fine. So you can see, yeah, those ones were hit again. So this is kind of making a base now. So what you could do if you're feeling risky, you could buy in this area and have a stop loss down there. All right, so it moved down even more. What is that? Oh, that was 20,000. Okay. So yeah, that would have been good right there. You would have gone out at like 12,700. You could have even raised this higher up to 15,000, or some people make some tight stop losses. I mean, that's not really that tight. That's like from there to there, that's 16%. Some people, well, day traders, they set stop losses in the range of 1 to 4%. I'm not really going to get into that. Technically, it's based on your position size. So even if it is a percentage, you put the correct position size to the amount that you're willing to risk. Anyways, very, very important to be taking profits whenever you can, because you really have no idea what the market's going to do. And if it's going up, it'll always come back down. You don't know exactly how much, but you want to protect yourself, protect your capital, and not be put into a position where you lose a lot of money. So if you learned something from this video, please give it a like, smash that like button for me. Subscribe if you're new to the channel. I also do updates on crypto news, and comment below on what other exit strategies that you may have employed, or that you've used, or that you've heard of, and let me know what kind of video you would like me to do. And thank you so much for watching. Have a wonderful day.